In this week's video, we'll review the latest charts, data sets, and scores to help us answer the question, is the stock market rally sustainable? We'll be moving quickly, so feel free to use the pause button on your video player. Here are some of the topics that we'll be covering and questions that we'll be asking. And it's becoming more and more likely that the answer to this question is yes, as it relates to Fed policy. If you follow the markets closely, you may remember on November 30th, 2021, that was the day that Jerome Powell dropped the term transitory. That was not a particularly good day for risk assets. Fast forward to today's session, Friday, December 1st, 2023, and we now have what appears to be a much more favorable backdrop for risk assets. Earlier today, Fed Chairman Powell participated in a fireside chat. Prior to that conversation, there was a 43% probability that the Fed was going to cut rates sometime between now and the March meeting of 2024. After the release of Powell's prepared remarks, and after that conversation, those odds improved to 65%. A month ago, this 65% figure was under 15%. Thus, are these fairly significant shifts in Fed expectations reflected in the charts? And as we try to answer that question, let's keep these concepts in mind. Technical analysis tracks the past, it does not predict the future. You have to use your own intelligence to draw conclusions about what the past activity of some traders may say about the future activity of other traders. November 30th, 2021. That falls about right here on the chart that you're looking at. It's probably fair to say that there was a discernible shift on this chart after November 30th, 2021. Short-term corporate bonds moved from here to here in relatively short order. And when the market bottomed in October of 2022, short-term corporate bonds ran back to an upward-sloping 50-month moving average and, for the most part, ran into a brick wall. And since then, have been moving sideways, consolidating underneath that 50-month moving average. I think it's fair to say this is a discernible and noticeable shift, just as this was a discernible and noticeable shift. Similar concepts here. Weekly chart of Capital One Financial spent most of calendar year 2022 below a weekly cloud and below a weekly red cloud. This, above the cloud, looks different than anything that we've seen back here. Similar situation here. A very tight cluster. In October, price came back to an upward sloping 250-day moving average in black and held. It's almost the mirror image to what happened up here. In November of 2021, price came back near a flattish to downward sloping 250-day moving average in black and failed. Similar situation when we look at the weekly cloud. 2022, we can check all of the bearish boxes. 2023, we can check all of the bullish boxes. Upper left-hand corner of your screen, notice there was a long-term period of consolidation and indecisiveness after Powell's remarks. That broke in a bearish manner. This is early 2022 here. Similar situation here. A long-term period of consolidation and indecisiveness. This is a base down here. And now it looks like we're breaking out of that base in a convincing manner. Nothing definitive here, but this is a good sign. Emerging market bonds trying to break above that base and doing so above the cloud. When we look at these ratios, we have to think, what is this telling us? High yield bonds produce a higher yield. How can they do that? They're riskier. There's no free lunch in the markets. If you're getting a higher rate of interest on your bond, whether you know it or not, you're taking additional risk. Thus, if market participants believed a severe recession was right around the corner and credit defaults were about to spike, I don't believe that they would prefer to own riskier and higher yielding HYG relative to more conservative 3 to 7 year treasury bonds. And if a recession was right around the corner, we wouldn't expect this long-term period of consolidation to break in the favor of high yield bonds. If Shown this chart previously, it appears that this area of possible resistance, at least in the short run, is acting as a resistance for interest rates. Let's go through one anecdotal example here. Financial crisis, US dollar relative to the S&P 500 breaks above the 200-week moving average here in 2008. It doesn't come back to that 200-week moving average until after the major low in 2009. Similar situation here, similar situation here, and similar situation over here. The VIX during the bear market, the VIX today, this is discernibly different. It's a monthly chart of the VIX. If we used a daily chart, we would draw the same conclusions. 1998, here's a fear spike. We came down to this green line here in 2005. Good things happened for several years in the stock market. 2008, we come all the way up to the top dotted horizontal line. Have a second spike in 2011. And then when we get back to this green line down here, good things happen in the stock market for several years walking forward from 2013. Make an argument, we have a similar situation here. The big spike came in 2020, COVID fear spike. Secondary spike here, similar to this secondary spike in 2011. And in a similar manner, we've come from here back to the green line. Daily chart of XLF Financials, hanging in there, consolidating with a nice tight cluster look in here. Larger chart XFI held in 2009. Really good things happened in risk assets out here. Held near the COVID low. Really good things happened in risk assets over here to the right. Thus far, trying to make a stand near a logical level in 2023. Covered this numerous times. BIL divided by XLK in the ETF world. The only other time this has happened up here, 2009, it's happening again in 2023. Price dropping below a green cloud. Tweet from earlier this week. Here's the Twitter handle. I'm watching this chart for some time. This looks like a constructive move above the all-important 200-week moving average. This doesn't look like a credit market that's concerned about an imminent recession. Also from the Twitter feed this week, told us to keep an open mind about a bullish resolution even in the short run. Earlier this week, JNK high-yield bonds clearing this extremely important level here related to anchored volume-weighted average price bands. Purple line tied to the 2021 peak. This is the bear market. We came down, undercut that line in a scary manner in October, and then we held. That's also the area tied to the 2022 low here. This is a very constructive look. The longer it holds, the more meaningful it becomes. Weekly cloud, similar situation. This, 2022, really doesn't look anything like this in 2023. It's been a different year in the stock market. The S&P 500 has done well, but mathematically, those gains, for the most part, have been driven by 7 stocks. The other 493 stocks, for the most part, have been flat over the last year. Logic tells us that's probably not sustainable. Thus, regardless of whether or not you own those 7 stocks or have ETFs related to those 7 stocks, you would prefer to see market breadth improve. During Friday's session, breadth was improving and it was constructive. And some of the laggards, including the transportation average, $TRAN, trying to break out in a bullish manner here. RSI down here tells you we should be open to a bullish breakout here. This over here on your right shoulder, RSI looks much better relative to RSI here tied to the left shoulder. This quote tells us it's been difficult, but logic tells us if the market moves to the upside, participation absolutely, positively should broaden out, and it should get a little bit easier to make money in a diversified manner rather than a super concentrated manner. Also a very good look relative to the anchored volume weighted average price lines. For the first time during Friday's session, price was able to get above those bands. If we review these charts that follow in an objective manner and ask, from a long-term perspective, does this look bullish or does this look bearish? It should help us assess the probability of good things happening relative to the probability of bad things happening. Large chart on your screen dated October 31st of this year. You may remember October was not a particularly friendly month for stocks. But in terms of keeping an open mind about better than expected outcomes, we covered these concepts on November 3rd. You can pause your video player and look at this chart in more detail, but when blue goes back above red down here, it was after the bear market was over. This is 2003. Similar situation here, blue above red after the bear market was over in 2010. And at the end of October, we had a similar keep an open mind look, and it really didn't look anything like February of 2001 nor July of 2008. And in both of those cases, really bad things happened walking forward. And this blue cross here at the end of October looks similar to these bullish crosses during the secular trend from 1950 to 1968 as well, and similar to these bullish setups during the 1982 to 2000 secular trend. The market did respond. This is the S&P 500 same chart at the end of November. On November 30th, the S&P gained 8.92% in the month of November. Look at the same chart for SPY, the S&P 500 ETF at the end of November. That gain was 9.13%. Again, from the November 3rd, keep an open mind about better than expected outcomes video chart dated November 2nd. We said this typically is a constructive setup. Fast forward to the end of November, and we still have a constructive setup. This looks a lot like this in 1988 after the 1987 crash, and a lot like this after the double dip downturn in the stock market in 2015 into early 2016. When we review these charts, we want to ask, historically, what we're looking at, is it associated with ongoing bear markets, or is it associated with the end of bear markets and the early stages of a new bull market? Left-hand corner of your screen, this sliver of a chart, this is April-May 1973. S&P 500 at that time is still above an upward sloping 200-week in red, but momentum down here, PPO, waving some yellow flags, dropping below the zero line. For the most part, an identical setup in Q4 of the year 2000. Price above an upward sloping 200-week PPO, peeking its head below the center line, indicative of waning weekly momentum. Same can be said here, early 2008, price above an upward sloping 200-week PPO drops below the zero line. This looks different relative to this. And these yellow flags here with PPO dropping below zero turned into red flags. S&P 500 eventually gave up the 200-week moving average in red here, gave it up here, and gave it up here. And during these three devastating bear markets, PPO never recaptured the zero line on a sustainable basis. And in all three cases, the 200-week moving average started to look more and more vulnerable. And these early yellow flags relative to PPO dropping below zero turned out to be valuable because from peak to trough in all three cases, the drawdowns and the hit to an investor's net worth were significant. Now let's continue to walk forward in all three cases to see what we can learn. In all three cases, price and momentum started to improve, with PPO starting to try to recapture that all-important zero line. But at this stage, something similar has happened during these bear markets, and in all of these cases here, momentum failed near that all-important zero line. But these cases produced a discernible and noticeable shift. PPO well above the zero line, PPO well above the zero line, and PPO well above the zero line. Price also was able to make a higher high, a higher high, and a higher high above this high. And while these "this looks different" looks don't predict anything, In all three of these cases, they would have told us to keep an open mind about better than expected outcomes. And if we continued to walk forward, in all three cases, momentum started to wane again. But in this case, in 1975, PPO held above the center line. In 2003, PPO held above the center line. And in 2009 and 2010, it held above the center line. Eventually, black back above red, black back above red, black trying to recapture red. And in all three cases, with these looks, very similar looks, historically, the bear market was over, the bear market was over, and the bear market was over. Thus, it's logical to ask and answer. How does the present-day market compare? Since the three looks on your screen are very, very similar, let's replace the chart in the center of your screen with the present-day chart. Right off the bat, this should catch your eye. Like the three cases we just covered, PPO earlier in 2023, and PPO is very, very similar to MACD, was able to recapture and hold that zero line. And very, very similar to these historical cases, momentum waned, and on November 24th, black was above red again, telling us to keep an open mind about this newly established uptrend resuming. And it's also noteworthy, in these three bearish cases, look at the damage to the 200-week moving average here, here, and here. And look how long PPO stayed below the zero line and could not recapture the zero line. In each case, well over a year, and in some cases approaching or even exceeding 2 years. All of that told us at that time in each case that the economic negatives were far greater than the economic positives in this window, and this window. And that's what a period of secular stagnation looks like. So how do we compare again in the present day? Better, worse, or about the same? First, PPO only stayed below the zero line for approximately a year, quite a bit shorter relative to the three historical cases during periods of secular stagnation. And the significant difference? In October of last year, we made a stand above an upward sloping red 200-week moving average. This really doesn't look anything like this. It really doesn't look anything like this. And it really doesn't look anything like this, telling us that this doesn't apply to our present situation. It's not clear here that the economic negatives far outweigh the economic positives. In fact, you can make an argument with the upward sloping 200-week and PPO back above zero that the economic positives are starting to outweigh the economic negatives. Once again, telling us to keep an open mind about better than expected outcomes looking out 1 to 3 years. Calendar year 2022, the 50-day in blue tries to come back to the 200-day in red and is rejected. It looks quite a bit different relative to what we've seen in calendar year 2023, including what we have near the end of November 2023. This is a convergence of trends look here, with the 50-day appearing to get back in line with the upward sloping 200-day in red. They get back in alignment here with positive slopes. They get back in alignment here with negative slopes, and the faster moving averages on the bottom, faster moving average over here on the top. And this is not the S&P 500. This is the much broader S&P 1500, telling us to keep an open mind about the equal weight S&P 500 index and other sectors outside of tech starting to perform in a more constructive manner. Said another way, it's possible that walking forward, we're not going to be heavily dependent on just 7 stocks, and those other 493 stocks in the S&P 500 can start to do something other than, for the most part, move sideways. If you've been doing this a long time, seeing the 30, 40, and 50 week look like this is a constructive, strong, and sustainable uptrend look. When we review the following charts, we should ask ourselves, what do these charts tell us about long-term odds? And what do they tell us about trying to ignore day-to-day, month-to-month, and even quarter-to-quarter volatility? Constructive setup in 1988. It comes after the major low in 1987. Constructive setup in 2004. It comes after the major low in 2002, 2003. Constructive and similar setup to what we have in 2023 and 2010, and it comes after the major low in 2009. Covered these charts many times. They become more meaningful at the end of the month. If you review this chart objectively, it is constructive when monthly Copic comes from below the zero line and recaptures the zero line. Once again, it happens after a major low after the 1987 crash. It happens after a drawdown in 1990. It happens after the dot-com bust bear market. And it happens after the financial crisis bear market. Those are the only times it's happened in the history of the NASDAQ 100. Very similar situation here. If you know your market history, something that's similar to 1982, 1984, 1988, 2003, 2009, 2016, and in the future, similar to 2023, historically that's been a very constructive setup, and we have it in the present day, and we have it nailed down as of November 30th. Everything that we just said about the previous charts also applies to the S&P 500. 1974, 1978, 82, 88, 90, 2003, 2009, and 2023. Once again, the similar looks occur during very constructive and bullish periods. Typically, good things happen for a long period of time after a look like this. Covered this earlier for the S&P 500. We also had that constructive setup back on November 1st in the NASDAQ 100 with blue above red. Fast forward to the end of the month. It turned out to be helpful. The NASDAQ 100 gained 10.67% in the month of November. Dow is trying to break from a multi-month period of consolidation. And earlier this week, it printed its highest closing high for calendar year 2023. Weekly cloud trying to get to a point where it can check all of the bullish boxes again. NYSE Composite made a stand here at that all-important upward sloping 200 week. S&P 500 financial sector thus far holding these important levels tied to this peak here in 2007. Resistance, a little bit of a stall in here. Resistance, stall, and resistance. Recently support. Constructive look with the 30, 40, 50 week. Given that we've looked at charts and markets and ETFs on multiple time frames, it's fair to ask and answer, does all of this seem to align with or contradict the theory that we've outlined in great detail on our website that we are currently in a demographically induced secular bull market that could last until 2035? And walking forward, given the secular shift in interest rates, returns for balanced portfolios, stocks and bonds, could be extremely disappointing relative to what investors have grown accustomed to over the past 30 or 40 years. And all of this aligns nicely with the concept of the Roaring Twenties outlined by Ed Yardeni back in 2020 here on the left side of your screen, and reinforced here with this quote on November 27th. How about the labor market? Resilient? Yes. Wall Street Journal. There were a seasonally adjusted 2.4 million more jobs in the United States than a year ago. And workers in the United States, according to the Wall Street Journal, don't appear all that worried about losing their jobs. This is something that we've talked about for a long, long time. Common sense tells us if someone's not afraid of losing their job, or they haven't lost their job, what's their motivation to curtail their spending? The fear of losing your job or actually losing your job tends to be the first recessionary domino to fall. And that domino may fall very, very soon, but the data that we have in hand today, including this data here from the Wall Street Journal on November 22nd, 2023, just don't align with the theory that a recession is imminent. And the theory that the cash that consumers had built up during the pandemic, that was going to exhaust itself in September of this year, Well, it's now December of this year, and that just hasn't happened yet. Still have $433 billion of excess savings on their balance sheets, and savings remain elevated across income groups. And so far, the concerns related to the resumption of student loan payments, they're not showing up in the data in a negative manner either. You can find this graph and this tweet on our Twitter feed here, but typically it's a good thing. 1974, 1982, 1990, and 2009, when the Bloomberg Economic Regime Index, the 6-month moving average, starts to rise again from very low levels. And that's what we have in the present day. Does the present day market look more like the charts on the top of your screen? Or does it look more like these periods of secular stagnation on the bottom of your screen? On December 1st, 2023, the answer is easy. The present day chart looks a lot more like the charts on the top of your screen, and it's also noteworthy that on December 1st, 2023, XLK was exceeding and had already exceeded the prior bull market high here from late 2021, early 2022, telling us to keep an open mind that even if XLK takes a break in terms of leadership, it's quite possible that the S&P 500 is going to do the same thing, meaning it would exceed this high. Not a prediction in any shape, form, or fashion, but it's hard to argue that this is not a positive sign. And while this subjectively looks a lot like a secular trend, what about the objective data? We scored these during the session on Friday, December 1st. Score A, telling us how strong is the present trend within the context of a secular trend, 97 out of 100. Score B, does it still look like we're in a secular trend? 100%. These concepts here, these scores here, and this research here that you can find on our website by Googling the title on your screen, tell us to keep an open mind about much better than expected outcomes, looking out 1 to 12 years. They also tell us that we can learn to tolerate volatility and some swings in our account balances. The rewards, several years down the road, could be extremely satisfying. A lot of information available on our website. It's a drop-down menu on the upper right-hand corner of the screen, including frequently asked questions. We don't have anything in hand that negates the secular trend thesis, telling us that opportunity in the markets is probably much, much greater than most believe. But we all know the only way that we can do any of this effectively, especially relative to this concept in the upper left-hand corner of your screen, is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.